Well, welcome everybody. It's Sunday, 16th of March, and thank you for joining me. Our subjects today is triangle. There are so many different types of triangle, so we will only be able to consider some of them, and perhaps only at the very basic level. But hopefully, it may give you an opportunity then to do your own research and learn some more regarding the triangles and where they occur and what implications they have. So, just to remember the fact that we are discussing technical analysis and it is purely educational to encourage you to do your own research and learn more so that in your actual application you will be able to do so with your own discretion and your responsibility that you will shoulder for whatever decisions you make. However, I think there are a number of things that we can do in order to learn various different types of approach to technical analysis, and many of you use different forms, and I'm sure that to varying degree we will have found successful in applying them, but nevertheless we're always on the lookout for possibly something that could give us a consistent edge or help us to understand the general development of a particular cycle and how far it's likely to go. So much of this will result in us coming to a particular conclusion, and then of course based on that conclusion and our understanding we would take a possible step to either enter or exit the market. So let me first of all take up a chart that is going to be blank. Well, when I say blank, I mean hopefully we're going to use the blank surface because I need to try and illustrate a few things to you before we come to specific charts. Okay. Once we finish the session, then of course there'll be lots of question and answer opportunity for us. But let me first of all get a blank area. Okay. So what you may do is just get into a concept of understanding what the triangles are. Okay. So in terms of the triangles, you might see a triangle that looks like this, like that. Okay, these are just approximation of the kind of triangles you might see. Then you'll see one like that. Both of these are called kind of a wedge. This one of course a rising wedge, and this one as a falling wedge. So that's one type of triangle. This is a slanting up, and this one is slanting to the downside. Now the next triangle you might see are where you have, for example, a horizontal line, and you'll see a triangle like that, and in a opposite direction you'll see a triangle which looks like that. So that's another group of triangle. Then you will see a triangle which is what we call symmetrical triangle. Okay, so this can happen in both market rising up or market coming down. So whether the market is coming down that way and then we have a triangle, or we could have a situation where we have a market coming up from the bottom and have a triangle. So you have a symmetrical triangle, and then you will also find on occasion, not often but on occasion, a triangle that looks like that, what looks like to be a megaphone. Now these are just the concept. So in this concept the real live action or the market price might not often be like a textbook. There will have to be some degree of variations of these particular shapes. So what we have now is just to identify and then we will consider the one particular group of them. So this one is one group, okay. Maybe what I should have done is, let me just make this one very light color. And have this one over here. Okay, so that one group of triangle, and then we have like an expanding and contracting triangle, so that's another group. Okay, so one that we are going to be looking at is basically a variation of this one here. Now in Elliott wave, before we go into that one, let me just also clarify that this group here usually happens either at the beginning or at the end of the cycle. So for example, if you see market coming up from the bottom like so, then what you might see is basically this kind of pattern. And of course that would be an ending, and we would then on completion of that expect to see a major change in trend. Likewise, if you see either from the top or from the bottom, if it was from the bottom, then for example you might have a market coming down like that, makes a low, and then it forms that kind of a triangle. Now when it forms that kind of a triangle, market coming up from there, so I would make this one, for example, because we are looking at potentially a cycle change coming from high, we create a rising wedge, then chances are that this market would come down and then continue higher. So whenever that happens, because this is starting from the beginning, we call this one like a leading diagonal. So it's the beginning of a new trend. However, if the market is coming from the bottom, then it's already traveled substantial way, then this is likely to be the ending diagonal. So this kind of a pattern happens only in two places, either at the beginning of the cycle or at the end of the cycle. Whether the cycle has started from the bottom and this becomes an end, or you have a cycle coming from the top and this becomes the beginning of the cycle. And of course you have the opposite direction as well. So that's the beginning of the cycle. This kind of things here and these here happen somewhere in between. But this kind of pattern in particular, and I will actually do this one here, okay. So we have, let me just take that off. Okay, so what we have here is now a bullish one, for example, that comes in from there, then it oscillates in here, but it then leaves the triangle with a bullish move. And likewise we can have the opposite one where we come in from the top, and we'll make that one look red. Okay, then it oscillates in here, but in the end it leaves the triangle like that. So in that particular way we've got this triangle happening somewhere in between, but it happens in a very specific location, just like the rising wedge and the falling wedge that we discussed here happens either at the beginning of the cycle or end of the cycle, never in between. This one happens in between. It's never at the beginning and is never at the end. However, this triangle happens after a move has commenced. So for example, if it's a bullish move, it has already started and then it enters into the triangle, but it leaves. So when it leaves, this kind of a symmetrical triangle happens where you have, once the market is broken, this breaking out is the last leg. So in other words, it happens prior to the last leg. So whatever cycle it is, how many waves it's come into, whenever you see a triangle like this one, it breaks out, but then the market doesn't continue indefinitely. It only comes in to the triangle, leaves the triangle, but once it leaves the triangle, it's a final leg. So that is the important part to remember. It's a final leg. So in other words, when this market is finished, you would not expect a market to continue just going up and up and up and up like that. Okay, for that particular cycle, it may recommence. You may have a situation where market makes a move like that, so it leaves and does the final leg up. Then you'll have a correction, and it's possible then market to resume, but that would be a new cycle. Okay, so for this current cycle, we would find that it's the last leg. So because it's the last leg in the Elliott wave, it happens either in a wave 4 or a wave B. So this kind of a triangle happens only in a wave 4 or wave B. So let me now just give you a sketch of what those waves are. Okay, so cancel that one. So if I just show you here now, we may get, for example, a bullish move where you have wave 1, and because it's bullish, I'll make that one blue color. Okay, so we have wave 1, then you get a retracement, wave 2, then you have a wave 3, for example, then you have a wave 4, and you have a wave 5. Okay, or you might get wave A, wave B, and wave C. So once we identified that, you would see a triangle in this location here. A symmetrical triangle like that, or in this location here. So you would see, for example, okay, so that's a form of triangle you would see. So this would be wave 4 and this would be wave B. So this for example would be wave 4, and this one here would be wave B. And what we are trying to say in that is that that triangle is the last correction or a congestion for the final leg up, either in a wave form of a wave 4, or you have a wave B and it's the last leg out. So we will come to the specific examples in a moment, but one of the guidelines you also have to consider in this one is, how do you know that whilst it's the last leg, is it going to be what I would call a restricted triangle or unrestricted triangle? And what I mean by that, is that this is the wave 4. So wave 5 can be relatively short, or wave 5 can be quite a long one up, right? So in contrast to whether this triangle being the last congestion, are we going to get a massive leg up, or is it going to be relatively short? Okay, same again with this wave B. You know, if we have a triangle where we get congestion, wave B, and then we get, so A, B and C, and in that leg C can be either relatively short or it could be very, very long. So which one is it going to be? Well, whilst there's no 100% way of telling which one, what you have to try and remember is where this wave 3 or this wave B ends. So for example, if I was to put a vertical line on it there, and likewise here, okay, so when you see in the real life how far is this going, so you basically draw this triangle so it actually meets at the apex. So if you see that distance, then what I would do is you do, in fact on this one I often struggle to put a Fibonacci on there, but you could do a Fibonacci. I often do it, for example, on this MT4. I can put in this fib time zone, okay, this fib time zone, so I can quite easily do that. But on this one I haven't quite been able to apply that. But the point is that if, for example, this represents 100% from the beginning to the apex, 100%, then you need this breakout at least 80% into the triangle. If it is 80% into the triangle, then this leg can be quite strong. If, however, you find like a triangle is taking so long to break and it almost travels into, you know, more than 80% into the apex like that, then the breakout is going to be very limited. So this, if it goes almost toward the end, is going to be limited. If it happens within like a, you know, 2/3 of the way ideally, but maximum 80%, then chances are that this leg would be quite long. Okay, and when I say quite long, I don't mean indefinitely long, but usually the other technical analysis suggest that if you measure the height of the triangle like so, and then apply that to the breakout, then often what happens is it gives you a potential target. If I can grab all of the line. Oh, so that wasn't a good one. Okay, so if I apply that over here, it gives you a potential target. But if the breakout is such that is happened within the 2/3 or 80%, then most likely we will exceed this. So this leg could be longer than the actual height of a triangle. But in contrast, if you get this one going almost toward more than 80% and toward the end of the triangle, then the chances are that the height of the triangle is most likely going to be the breakout target. Okay, so in other words, that would be a limiting triangle. But if it happens by 2/3 or 75% or 80% maximum, then we could have a breakout which is likely to be longer than this. It still has to be in concept of overall dimension of the whole cycle, but it's likely to be longer than the height of the triangle. And sometimes it can be so strong that it might actually turn out to be the longest leg out of the cycle of 5. Okay, or in this case, out of the A, B and C, it could be longer than the length of the wave A. So those are just the guidelines to follow. Then you have to use other technicals to enable you to actually pinpoint the prospect of likely move out of the triangle. So if you don't know Elliott wave at all, and you probably have no intention really to learn anything more about Elliott wave, then I suggest that you at least learn these three groups of triangles. One group is a rising or falling wedge. Then you have this what you call a right angle triangle, usually breaks out to the upside, or you have this declining right angle triangle, usually breaks out to the downside. However, if you see this symmetrical triangle like the ones we showed here, those particular type of triangle only happens in two places: wave 4, which is the last congestion before the final leg, or wave B, also last congestion before the final leg. So in case of a wave B, you might say, for example, it goes up to there, so it starts off from here, you get minor A, minor B and C. Okay, so, so once we've had that, then what you would see is a reversal of the trend, and generally speaking that would have started off like so. So you would have had a decline, a retracement, and then continuation in that particular manner. But as far as this cycle is concerned, it's the last leg up and then the trend changes. Whereas here, likewise, the last leg up and trend changes, but because this has been bullish, it may not actually change all the way to the bottom. It could do, but doesn't have to. It can come back to approximately where the triangle is and then continue higher for the next cycle. So now with that understanding, let's see some examples. Okay, so I will come to Bitcoin in a moment, but let me just show you historically what has happened. Now this is the Nikkei Index, and it's something that has happened recently. This is the Nikkei Index, and in a longer term, just so that you understand, Nikkei Index, as far as this particular chart is concerned, takes me back to is here 1984. Okay, so it's a chart that I took from Yahoo Finance site on August 23rd of August 2013, and where over here in the reading you'll see it started off from about 10,000. Now I don't have a chart history prior to that, so assuming that that's the beginning, then we had this massive run up with a major top in 1990, then the markets come down. Okay, now we have examples of two types of triangle, so I'll illustrate that in a moment. So we have this massive decline, and it appears as though it's still in a process of declining, because whatever that move was is correcting that, and it's taken long time to correct, because the market must have started, although this one says 10,000, but if you went back to maybe like 1980, 82 or something, I think that this market must have started off from quite a low level. Okay, so at the moment it is coming down, and you can see in a rudimentary way, this one is wave 1, wave 2, wave 3, wave 4 and wave 5. So that's a 5 wave down to give me cycle A. Then we have a wave B, this wave B here, actually it should be, just keep it on the other one. Okay, so then we have a wave B, and then finally, so remember we said cycle wave A, B and C. So within the C we are seeing a potential example of a falling wedge. So you can see at the top, starting off from here, we have a line declining, but from the bottom we also have a declining line, but the declining line at the bottom is less decline than the one on the top. So what will happen is, this is the widest part, then it gets narrower and it gets narrower. So when I took this snapshot, the price was hitting the top trend line, and in terms of the actual chart, this is where it was. Okay, so if I now contract this one in, you'll see that we have the top line is declining and the bottom line is declining, but this is wider than what we have here. So what we may have here is like a falling wedge, and is going to conclude with this last leg coming down. and at the moment I think we have made a top. The Nikkei Index is now in a process of actually coming down. So within that there is an example of symmetrical triangle, and this is where it is. Okay, hope you can see it. So we had a market coming up very strong, wave 3. So then we have a triangle. So this triangle gives you wave A, B, C, D and E. In other words, there are 5 points in a triangle. Remember we said symmetrical triangle. This one is symmetrical, but remember this point is quite high. So ideally you would have liked to have a trend line like that. But remember I said that sometimes you don't get a textbook pattern, but if you ignore the wick, then you nearly have a textbook pattern. For example, if you connect it like that, okay, then you have like a triangle. And what has happened is it's happened in a wave 4, because if you look at the overall count here that I've got wave 1, wave 2, wave 3, a triangle in the form of a wave 4 with a final leg up to give you wave 5. Now because this triangle lasted a long time, it didn't break out as you can see within where it should have broken out. So it's become a limiting triangle, and the limiting triangle is, we measure the height of that and apply it from where it breaks out, then that is a likely target. In this case it actually didn't even make that. Okay, so it's called a limiting triangle, and that's a kind of insight you can gain into. I know a lot of people find Elliott wave very difficult, or Elliott, people say it's a hocus pocus, or Elliottians forever keep changing numbers and keep adjusting these things until it looks right. Well, I accept all of that. I mean, when something is not certain, your mind begins to contemplate one possibility, another possibility, and sometimes there are quite a few different permutations. And all I say is that in logical analysis, there are no 100% way of analyzing any market. Whether you use moving averages, Fibonacci, trend lines, pitchforks, Bollinger Bands, you care to name any number, and all of these are method of trying to attempt to gauge what the market is doing and what is the likely outcome upon resolution. So if you just accept that that is the exercise, then I think that if you can ever see a triangle like this, and whether it happens in a wave B or a wave 4, which are the only two places it can happen, can never happen anywhere else. It will never happen in a wave 2. Okay, so it can only happen in those two places. Then you already got an advanced knowledge of where this is likely to go, because whatever comes out of the triangle is likely to be either a limiting breakout, if it is taken nearly 100% of the actual formation of the triangle, or more than 80%, is going to be limiting breakout. So it's going to be last leg up, but the extent of the breakout is going to be limited. And if it is unlimiting, then you'd expect a breakout to be much sooner, ideally 2/3 of the actual formation of the triangle, and you expect a breakout, then that is likely to be unlimiting, meaning whatever breakout, it is likely to be more than the actual length of the height of the triangle. So that insight tells you that whenever that particular cycle is complete, you would be looking for a trend change. Now that trend change can be either a complete reversal or at least quite a noticeable retracement. So if you gain that advanced knowledge, even if you don't know just exactly how far it's going to go, or upon completion where the retracement or the trend change is going to lead to, but the fact that it's going to happen, that means now you'll be on the lookout, and you can trade these couple of different ways. You can either wait for breakout of the triangle, and generally speaking go for the height of the triangle, and of course you will use your money management and stop adjustment, etc., so that in case it didn't reach your target, you wouldn't then wait until it sort of reverses back on you. Okay, so that would be one way of trading it. Or you might say, well, this breakout is going to be limiting, is not really what you're looking for. You're looking for a larger cycle correction, in which case you'd be on a lookout for a possible high where you would be looking to find an evidence of market stalling and then going short. Okay, now how would you know that it's stalling? Well, first of all, remember in an Elliott wave, once you get a breakout out of the triangle, you get 5 waves. So over here, for example, strictly speaking, the triangle part is this one here. Okay, so the triangle part is up to here, right? So you get wave 1, wave 2, wave 3, wave 4, and wave 5, and then that 5 wave completes also the larger wave 5. Remember, this was wave 3 here. So if that was wave 3, this was wave 4, then we got a larger wave 5 done. Okay, now in that process you've got, see, a divergence between wave 3 and wave 5. So that's the way you actually use confirmation. Okay, so you use the confirmation. This is on a weekly, so you got plenty of time to assess where the market has changed. Now, one of the way you would do that is, for example, you have a higher low here and another higher low here. So ideally you want a trend line to help you check where the trend is likely to run out. So this is what you would do. Like any trend line you would apply, you would try and attempt to see when that particular cycle, as long as the prices remain above that trend line, then you are heading up. But once you begin to see a stall, now here general technical analysis would suggest that you had this blue bar, then you got almost what looks like to be a piercing candle. You've got potentially, you know, once that candle is closed, remember it's a weekly chart, so once that candle is closed, you've got a really good confirmation. If you use high to low rather, then it becomes an engulfing. If you only look at the actual the body of the candle, then definitely piercing candle. So that's a potential, not necessarily but potential reversal pattern. Then you have that suggesting that, you know, we have now RSI upon a close of that candle, RSI is already pointing down. So definitely, you know, we're looking for a trend change. Then you've got a second candle also showing red and is now threatening to break below the trend line. So that would be your confirmation that, you know, you've got a potential trend change. So if you were looking to short that one, you'd have to obviously drop down to a smaller time frame like a daily chart and perhaps find an opportunity to short. So if you then went to a daily chart and look at this pattern here where we just evidence a possible confirmation that the trend line is broken. So we had a down move, we had 2-bar retracement and then stalling again and began to come down. So on this one you could have gone short here because now you got a red candle, you got another follow-up red candle. So maybe on the bottom of that red candle you could have gone short with a stop above here. That's generally how you would do it. But you are not looking for $5 and $6 and $10 move. You're looking for a reversal or a substantial retracement. So for example, you've had a 5 wave up, remember? So when you have a 5 wave up, the retracement is not going to stop here. You know, in proportion to the overall move, you're expecting retracement to go somewhere. So if I go back to the weekly chart, then I can show you in context what I mean. So remember, we started a move from here. So this is the 1, 2, 3, 4 and 5. So any retracement is not going to stop here. You know, you would expect at least like a 50% retracement. So this has some way to move. It could even come all the way back down here, but it would at least come back like 50%. So this is something you could trade quite easily, you know, keeping in mind your position sizing and your risk in relation to your overall account size and etc. But this is somewhere to go. Now you can see already I have put in -1, -2, -3, -4 and -5. So what I'm expecting out of here is I've got this first cycle of a -5 wave done, and I think it's going to be a little lower than where the price is now. So maybe for another week or two we might see Nikkei Index continue to decline, either possibly to something like 13,800 or maybe just south of that. But once we've done that 5 wave decline, so you could have traded that, you would have had, you know, plenty of opportunity to make money on that side. But if you missed all that, then what happens now is, this is what I would expect. After this last leg down here is complete, I would see on a daily chart, I'd see potential divergence between this low and that low. Remember, we said wave 3 and wave 5 must have divergence. If you look at that in your own time on a daily chart, you will see that this low created on a daily chart, and then the next low being created will produce a lower low on the price, but it will be higher low on the RSI, suggesting that that cycle is likely to complete, and our wave count is telling us it's likely to complete. My fib retracement also, or rather fib extension, I've measured the height, or rather not the height, but total move from beginning of the cycle to the minor wave 3, applied it from 4, and there are some fib relationship between that move and the wave 5, and I'm expecting around about 13,800 is possibly likely to be an area where I could see that 5 wave completing. So then what I would look for, and this is what Elliott wave enables me to do. I have no idea what's going to happen, but what it enables me to envision is that once I get that low, I'll get a typical retracement, which will be A, B, C. It could be some different combination, but you go by what you think is typical. So I go like that, and then once I've got the total move, of course you can put in your normal fib retracements, i.e. like that, and you'll see that either 50% or 61% are common. So 50% or 61% are common. Okay, so that means I would expect it to go back to here 1500, or maybe just slightly north of that, maybe 15.5. Okay, the other thing Elliott wave tells you, or the guidelines, not necessarily a rule but a guideline, says that once the cycle is complete, retraces back to the previous cycle 4 of 1 cycle degree lower. So in other words, if this is the full cycle degree, 1 cycle degree lower is this 4. So that's where we would expect generally, and then you can see is double confirmed by the fact that we've got a fib 50% or 61.8%. So I would wait for ABC to complete, and that would be my really high probability trade, because then I'm not looking for retest of the low. I am now looking for potentially this market to go like that, right? So when I come to that, I would have to, technically speaking, I would have to have my stop much higher up. But maybe instead of using weekly, once I got this confirmed on a daily chart, I could see a confirmation that the trend has changed, and then I can enter with a stop just above the high. Then my risk will be relatively small, but I'm expecting really big swing, and then I have to be very patient, because this sort of thing is not going to happen within a week or two. It's going to take several months. Just like the previous cycle, we had this leg going up. See how dynamic it is. But look at it. It took from October 2012 to May 2013. So it's almost like 18 months or so. So this is going to take some time. It's going to take maybe 8-9 months, maybe 10 months, or longer. But you can then continue to use your general rule or method of managing your trade. But you're looking for really big cycle down. So my focus, in fact, when you see many of my charts, I don't really look too much on 15-minute chart and 5-minute chart, which, to be honest, it's really just a ripple in the pond, and you have no idea whether that ripple is caused by a tiny little fish, or is it a ripple caused by somebody much larger, but it has traveled from so far away that you only see the tiny ripple. And rather than it being a beginning of the trend, it might be actually dying of the trend. So how do you know how far a market is likely to move once it resolves? So I don't look at it that much. But if I want to, once I've identified my big picture, then I could begin to hone down and maybe drop down to daily chart, maybe 4-hour chart. And really, if I want to, I could go down to 1-hour chart. But I would tend not to. 4-hour and daily is more than enough, because I'm looking for bigger trend. and I don't focus. Once I enter a trend, then assuming that my money management is good, my risk management in terms of position sizing is good, then I have to be patient. That either if I'm wrong, I would be stopped out, and if that happens, I exit the trade without being stopped out, because you will see that your trade is not working, and if it's not working, that means something could be wrong. Then why wait until you actually get stopped out? So based on that, I would exit early, and I could still be wrong, but at least I will not have taken a larger loss. That's the reason why I would do that. But this particular chart, if anybody is trading Nikkei Index, either using futures or contract for difference or options, you've got potential head and shoulder. You can see it. You can almost now see it in your mind's eye that this is a major reversal pattern, and it's because after it has moved for nearly 18 months, and many people try and draw this head and shoulder pattern, both bullish and bearish, but they're only looking at it from the neckline. You see, it's not really valid head and shoulder. A valid head and shoulder means that you've got to have a substantial rise like we've got over here. Now this is the proper valid potential. If we get that formation on the right hand side, it will be potential valid bearish head and shoulder, and the breakout will be violent. It could be the height of the head repeating below as the minimum target, but it could go a lot lower. So we've now considered where this symmetrical triangle takes place, and we've also very briefly looked at a falling wedge, which is both explained in this Nikkei Index. And likewise, if you are a forex trader, then look at the US dollar yen pair, and just where the Nikkei Index, because there is a very high correlation between Nikkei Index and US dollar yen, whilst this one symmetrical triangle was being formed, you'll see something very closely resembling on US dollar yen. And US dollar yen likewise broke out, made a high, and is now in a downtrend. So potentially US dollar yen is now in a very bearish cycle. Previously, any people tried to short the US dollar yen have got burnt, but now people will get burned trying to go long on the US dollar yen. There are so many people still thinking the US dollar yen is now in a big bullish cycle up, but it's actually finished, and we are now in a down cycle. We are likely to at least retrace 50% of the rise from the low of 2012, and we may even go back to retest that low, but certainly will go on minimum cautious target 50% of the overall rise. Okay, so let's now come into the Bitcoin. Before I come to the Bitcoin, there is one more chart which I posted on the it's a New Zealand dollar, New Zealand US dollar. Okay, so you can go back, and regardless of what these instruments are, they happen all the time in different market. So don't ever believe that technical analysis don't apply to this market. That people often say that not because they have really tested it out, but they say that because of the limited knowledge. In my view, I'm not poking fun at anybody, nor am I trying to say that these people are ignorant, but I think because of the limited knowledge, they often try and say that. So this is the chart I just posted 3 hours ago, and what am I saying? I'm potentially suggesting a high degree short with a minimum target of coming to somewhere about 0.80. Okay, and it's a symmetrical triangle exactly the same way, but because this triangle is going on for so long, it's likely, if it actually comes over here, it's likely that it's going to be more than the 80% length from here of the overall cycle. So the breakout is going to be limiting. However, if it actually makes this low quicker, a sharp decline, and one of the other things that we may have covered in the past, or we might do in the future, is that this kind of a triangle, you get each leg is a 3 swing. In fact, we will do that in the Bitcoin in a moment. Each leg is a 3 swing. So for example, this leg down is a 3 swing, going back up is a 3 swing, coming back down is a 3 swing, very small tiny one up to here, retracement, and a final one down. Going up again is a 3 swing, 3 swing, okay. And this particular chart here, you will see, in fact, if I do it on a I don't know whether I can do a bigger one. Yeah, maybe. If you actually went down and looked at this part on a daily chart, is an example of a rising wedge. So remember I said that's a final one. Why? Because the price came in from here, retraced, and then it started going up. So it's already been rising. So this is the final one. So that's, I've got few things going. I've got symmetrical triangle, top of the range, I've got rising wedge, and it's also right combination. So in this kind of a triangle, you see 3 swing on every leg, and you need five points. You got A, B, C, D, E potentially. Now I could be proven wrong here, but my high likelihood and understanding is that we are going to come at least to this area here, around 80, and maybe even a little bit lower down to 78, but very cautious target, I'd say to 80. So that's the power of the symmetrical triangle. And once we get a symmetrical triangle, we would see a final leg out, which is what I'm suggesting here. Final leg out. So, you know, my other fib relations is telling me that potentially we headed towards something like 90 to maybe 95 before we see a reversal. This is the last leg. Once it breaks out, it will be the last leg. So then we will see a complete reversal of the trend. So check that out in your own time. Let me now go into the Bitcoin and see exactly where the Bitcoin is. So this is a very small time frame chart. You'll see I've been sharing this with you all the while. Okay, this is the hourly chart, but in reality, you know, there have been people for every candle up and down thinking that, oh, this is going to rise, oh, this is going to fall. But really, there's nothing, and this kind of a thing now causes a big confusion in the minds of the trader or analyst, and it's best to stay out, in my view. You might still be very shrewd and very quick. You know, if you're trigger happy and you really want to trade this kind of a thing, then yes, you might be able to make some money. But I think it's very high risk. I don't trade this one particular instrument, so I'm to some extent ignorant, and maybe you'll have to modify my comments. But what I'm trying to say is that sometimes on a very low volume, you'll get relatively widespread. Second thing is you have a trading fee, and then if your total move is likely to be $10 or $15 or $20 a part, or even $30 to $40 a part, but really you don't know that you're going to be catching the absolute bottom, and you don't know you're going to be catching absolute top on the exit. So you will be looking for confirmation. So maybe by the time you've seen a confirmation, you've already had maybe $10 gone, and then it's trying to go up like that, and then you see a sharp, you know, tail coming down. You think, oh no, this is going to come back, so you exit, and then you see it suddenly taking off, where you might not be able to re-enter, and if you did re-enter, you'll definitely get burnt. So what a point I'm making is that why agonize on $5 or $10? It's your choice, and you do exactly what you feel is right. But from my perspective, I think it's too much effort for what's worth. So I don't focus on that. And at the moment, I would simply keep walking this chart and see whether, first of all, it is doing what I want. Okay. So if I go on to the larger time frame, and this is the chart that I've published, and this is the triangle, and again, it's a kind of a symmetrical triangle, but it's not a textbook symmetrical triangle, because ideally what we would have liked to see on a textbook symmetrical, we would have expected this to be over here where this turquoise line is, because it is less slanting. Okay. Likewise, from the bottom, I would have expected this to be slightly higher to give you like a perfect symmetrical. But because this is not perfect symmetrical, it is slightly slanted. Now, some colleagues of ours made a comment that maybe this is like a declining, potentially right angle triangle. So what they're saying is because this low and this low are so close to each other, it's almost like horizontal, in which case what they're expecting this to be bearish. So that could be a possibility. So you had leg 1 down, 2 up, 3 down, 4 up, 5 down. But on that 5 down, this is likely to fail. If, however, this was a true bearish right angle triangle, then what we would have expected in here is that this would have been a cycle A down. Then you want a triangle, so you get wave A, wave B, wave C, wave D, wave E. So you would see potentially on that possibility, you would see this leg come down and then you go back up to complete sorry, I didn't press that one. So it would go back up. Oh, messing up now, just bear with me. Okay, so press this again, and maybe to make it different, we'll actually do this one. So it would come down like that and then go up. Why isn't it doing that? Okay, so press this one here, then do the line. So we would expect starting from your A, B, C, D, so we would expect this to go up, then for it to come down and break on this occasion. Okay, so let me just change the color on that. Format. Okay, so I would make that one a hole and this to be red, so that's what it would be like. Okay, that's what it would be like. So you would have wave A down, and then this would be part of B. Remember we said that triangle only happens in a wave B formation. So if this is wave A, then you get minor A, minor B, minor C, minor D, minor E, and therefore the wave B now finished, and then you get a breakout to the downside. So from that perspective, you know, we could still have that, but I am less inclined to think that that is the likely outcome. Okay, so my preferred scenario, so this is the possibility, by the way, something you keep in your mind, is a possibility, but my preferred outcome is that we have this is a symmetrical triangle and it's happened in a wave 4 formation. So on a larger time frame, this is what it looks like. This is a larger time frame. It's a daily chart. Well, maybe it's a three-day chart. So it's on wave 4 formation, because starting from this cycle low here, from the way that I'm counting, I think that this is wave 1 in bracket, wave 2 in bracket, and then this is wave 3 in bracket, and within that wave 3 in bracket you see 5 clear waves. You see 1, 2, 3, 4 and 5. So if this is the wave 3 in bracket, we would expect wave 4 in bracket, and therefore that wave 4 in bracket is some form of symmetrical triangle, and an outcome would be is that we will resolve this to the upside. Okay, now over here is another symmetrical triangle. This is what it looks like. See that? See, you got wave 3, this is minor wave 4, and you get A, B, C, D and E, and then we saw a breakout. So for that cycle, which cycle started from here, that was the last leg up. Okay, so we are getting something very similar. Now it's very unusual that we are getting the same kind of pattern again at a different cycle degree. And in fact, even here you'll see is kind of a triangle. It's a little bit difficult to actually notice, but it is a form of a triangle. Or this might not be a triangle, it might be what we call a running flat. So we got a very bit deep down, like A, retracement B, and then the C doesn't come down far enough, so it becomes truncated or is called running flat. So but certainly this one is a symmetrical triangle, and so is, I think, the current one. However, if we are wrong, then what we might find is if the symmetrical triangle doesn't play out, that is, then we will find that we've got what I think is market has come down and is created this like a cup and handle potential. It's not formed yet, but the problem is that once we had the high here and this low, we went above the 50% retracement. In fact, that of the first cycle we went up nearly like a 78%, I think it is 78 retracement, but then we've dropped. But subsequently we have now almost literally been struggling to clear the 50% retracement. So of this decline, the 50% retracement is there and we are struggling to clear that. And if you actually look at it in a bit closer, you'll see I've got two lines. This, by the way, is, you'll see, log scale. Okay, so you see two lines. One of them is actually this thick line here is just identifying where we had a pivot, and that pivot is the market oscillated both on either side with reacting with potential resistance and support at that level. So we are now basically hitting against that, and we seem to be struggling. Now struggling doesn't mean we won't be able to make it, but we certainly are struggling. So it's possible for this market to simply try to make another attempt but fail and then drop down. So that's a possibility. But if it did that, then we would have a triangle potential in the making. We've got A, B and C, so it's a three swing. Going back up, A, B and C is a three swing. Coming down is A, B and C, three swing. And again we've got potentially three swings. So just like the three swings I've shown on here, that's what we are currently looking at. So my expectation is that we would see this coming back to the bottom, and on a symmetrical triangle we need 5 points. So we go 0.1, 0.2, 0.3, 0.4 and 0.5. So that's another reason why I'm expecting that we should be coming into the region of 400 somewhere. It might, if it doesn't come all the way, it could come to maybe like say 430 or 450, but it's certainly going to retest this area before going up. The other point to remember is that in this cycle, we started this cycle from approximately this low here. So that is potentially like May 2012. So from May 2012 to the back end of 2013, so it took nearly 18 months. So some people say, oh, fractal, and there is a misunderstanding about fractal. Fractal at several degrees. Okay, so if you see this triangle, that could easily be a fractal of this triangle, but this triangle has happened on a wave 3 of this cycle, but this one is happening on a wave, not 3, wave 4 rather, and this one is happening on a wave 4 of a larger cycle that started from right here. So the implication is that the distance and proportion would vary. The shape might be similar, but the time it takes and the distances traveled would not be the same. So that would be the mistake if anybody wants to do the fractal. Sometimes people say, oh, we shift this fractal and we put it on the chart and it looks exactly the same. Well, it does, but it's a different layer. So on a different layer, you can't expect the actual distance travel or the magnitude or the actual time lapse to be same. Even though they look like it, it won't be the same because it's a different cycle. Just like you see like a cauliflower where the whole complete bowl of a cauliflower is much bigger, and then any of the small segment is smaller, but they, they look similar, but they have a different dimension. So from that perspective, I would caution against people just simply using fractal just like that. But the fractal can give you the likely shape, but not the dimension or the time. So the point I'm making now is this cycle, if my count is correct and is subject to that, if I'm wrong, then of course my calculations are wrong. But if my count is correct, then you can see from here how long it has taken. It started off from here approximately, and it went all the way to there. Okay, so it's taken 189 bars of this 3-day chart. Okay, so now you can't expect the correction to be over, because many people were arguing with me before, and they were saying that on a daily chart there were 3 drives to the bottom. So we had 1 drive retracement, 2nd drive retracement, 3 drive to the bottom. That means the market is finished to the downside. Okay, so that in fact didn't happen, right? And you can see that if it took nearly 189 bars, you could not expect that to be over within here, because the proportionately doesn't look right. If you have a big boom, you have some at least proportionate bust, and this is not going to be over. If nearly 200 bars, not going to be over within 5 or 10 bars. So that's first observation. Second thing is that this is taken nearly 190 bars. How many bars have we passed now? Since the high. So since the high to so far, we've only come 35 bars. So it does not look right. Okay, so how long is it likely to be? Well, you can do some kind of a fib ratios. So if you were doing this fib ratios and this one, I'd say at least 38%, right? So what does 38% come to of 190 bars approximately, right? So if I say 190 bars times 38.2%, so that's coming to something like 72 bars. So 72 bars means that is going to be massive. It's going to be 72 bars from here. It's going to be like, like over here. It's coming all the way to there, right? Just like when you see, for example, this April high, and this is where it finished. It's been rising from there to here, and it's taken from the high in April to the low in October. So it's taken nearly like a 6 months or 5 months. So in same proportion, if for example it takes 5 months, that's why I've got this 58 bars. So if it takes 5 months, that means we are looking for a potential low around mid-April. That's the soonest, mid-April. So in between, whatever happens, I am thinking that it's going to chop people about. Whatever happens, even if we get this here, even if we get this market breakout and makes this high, because potentially is possible. Remember, I said this is an alternative, and it will be preferable because this is so gentle. It is preferable for this one to be gently declining also. So in that proportion, we need this market to go up. But so far we are struggling to do that. So even if we found somehow momentum and this one broke out and gone up to here, for example, and then come down, you can see it's going to take longer time period. You can run other calculations to try and give you an estimate of where this is likely to end. But my perception is that it's going to be mid-April is probably the soonest. And a couple of other observations you make here. We had this, let me say this one here. We had this high. Okay, that was toward the back end of the year, back end of the April and early January. We had this high, which happened again like back end of the year. Okay, so that's interesting that we had this high and that high both in back end of the year. We likewise had this low in October. but the high in April. So this was the back end of the year. Could it be that this could be, so this was in November, by the way. So if this was in November and we have this one in April, either mid-April or back end of the April, then potentially it's like at least 5 or 6 months, which will be something similar to what we had over here, right? And in terms of the overall count, we are expecting this to be a symmetrical triangle, even though it's not ideal. So in order for that to happen, it's got to pan out somehow. So this is the earliest, but more likely we could see 222 bars here. That could be like, I don't know when that is coming up. I can't read the scale on there. Yeah, I can't read the scale. And the reason why this one is 222 bars is basically I've done like this 300 bars, and I did, supposing if this has taken that long, if this one happens to be about like a 50% or 61.8%, then that's why it's coming over here. But for that, I would expect some more chopping about, possibly going up there and then coming down. But whichever way it happens, even if you get a new leg up here, many people will say that's it, we're in a big bullish trend. But it's not a bullish trend. It is still part of this triangle. And then we would be expecting for it to make a new low, or at least come back and retest this low to complete this triangle. And one final point is, many have said to me, let me go to a small one here. Many had said to me that why could this not be a new move? Okay, now once we conclude that if this was the end of the correction, we expect a new correction. I mean a new uptrend, new impulsive uptrend. So initially this upthrust has making of a new uptrend, but the new uptrend must have 5 waves, just like the one we saw in the Nikkei Index, and similarly in other charts previously. You need 5 waves. So if I just take this away here, and this is the reason why this is not an uptrend, because we need a clear 5-way move up here. And this is the hourly chart, remember, so you can't really go much lower than that. But you see, if you look at this one, and you can try and check this out in your own time, if you look at this one, you can see started off from here. Maybe there were some ups and downs, but possibly this is the full leg up. So what would we call this one? Wave 1. This one comes down for wave 2. Okay, so then we need a wave 3. So we have 1, 2, 3, 4 and 5. So say we have wave 3 complete, but then where is the wave 5? And wave 5 cannot be this one, wave 4 and wave 5, because remember we have this as a wave 1, this as wave 2. So if this was 3, this was 4, this is 2 deeper retracement in overall proportion to the wave 3. This has come down so far. Normally you only expect like a 38% or 50% retracement. You don't expect nearly 60, 70 or more percent retracement on a wave 3. And the other test is that if you connect wave 1 and wave 2, because that's what we are saying, then what you would expect is this kind of a rise. So if this was wave 1 and wave 2, then this price action should not have gone below that rising trend line. It should have been 1, 2, and it should have been 3, 4 and 5, like that. And so the very first leg lacks the evidence of it being impulsive, and consequently I am expecting that to be just part of the overall congestion, and hence is not a new uptrend. And then exactly the same way, talking about fractal, we had this 2 swing or 3 swing leg to the upside. Then over here you got something similar, but note that they're not identical. Here we had A, B and C. It's not identical to this one, but nevertheless it's the same kind of pattern that you saw. In that sense is a fractal, but it's not identical, so it's a different kind of a fractal. So far, just to conclude now, is that I think that we've got this as a potential triangle, I'm expecting this one somehow to complete and break to the downside, and I've left my original lines where they are, and those lines are not to tell you exactly where the price is going to go, but an outline of what I'm expecting. So I am not expecting, though I will keep it in the back of my mind, I'm not expecting this to break to the upside. Even if it broke to the upside, it will not be a new trend. However, I'm now expecting this to be a triangle. So I think from what you've just seen now, if this is some kind of a symmetrical triangle after having declined, then I'm expecting a resolution to the downside. So there is the conclusion of our coverage of a symmetrical triangle in context with other groups of triangles, and I'm hoping that you will find this useful both in your analysis, even if you don't understand Elliott wave thoroughly, or it will help you on your way to get to know what Elliott waves are. Don't be stereotyped. Don't try and dismiss things just because you find it hard to comprehend. Also, I may add that there are times when some Elliotticians or those who pretend to be Elliotticians start applying wave counts, and then their ability to apply wave counts are not very good. They have perhaps limited knowledge, and they will wrongly label and then soon find out that it's wrong label, so they'll try and adapt. Now adapting is nothing wrong, because that's the whole thing. If you expecting something, it doesn't happen, you have to adapt. So there's nothing wrong with adapting, but if you're constantly doing that, then sometimes that could cause some people to begin to scoff at the idea that Elliott wave works. But just because somebody is not doing it right, or just because somebody is adapting, don't be stereotyped and dismiss it, because if you do, it's your loss. And hopefully from what I've just showed you now, that if you do interpret it correctly, it can actually give you a view into the future, even though exactly what targets and what exact route is unknown, but you know the likely outcome, and that hopefully could position you correctly, whether you're in the market or you are looking to get into the market. So I will now is getting on to nearly hour and a half, so I will stop the recording here, and then I will address your questions, and if the recording has come out right, I will upload this one on a YouTube, that you may be able to then review it in your own time. And please feel free to interact with me and let me